Welcome everyone to our YouTube live session. So we're going to be with you for an hour and I'll try to keep it within the time and usual procedure. So members, people who support us on YouTube, our YouTube community, get pushed to the front of the queue for questions, as would people who ask super chats. So you get pushed to the front because you support us. So this is how we repay you. And then if we have time at the end, we'll answer other people's questions. And of course, the news this week, we've just passed 100,000 subscribers. We're at 100,400 and something. So we have applied for our YouTube Creators Award, but the nice lady who was in support said they have to run certain checks. So we're going to have to wait a week before we can order that. But we're going to get the award. And I think it might replace Teddy's picture in the background there. Sorry, Ted. You do get a kind of treat as a reward though. There you go. Yes. Good lad. Right. So, as I say, an hour together. Just to recap some stuff that's been happening as well. I actually got interviewed by someone called James Sinclair this week, who's a UK entrepreneur. And that's gone out live on his YouTube channel. So if you just look for James Sinclair on YouTube, you'll find it. And he's also got a 1-hour podcast of the interview. So we talked about investment.
I put the links in the description.
Oh, the links are in the description. Thank you, Laura. And yeah, so that should be kind of entertaining. It's kind of introductory, but I thought it would be interesting to some people. His channel's interesting because he goes much more down the entrepreneur route. So he sees value in investing in his own business. So I was just trying to show him why it might be a good idea, or convince him it would be a good idea to invest in markets as well as your own business. And also this week we had the Fed Minutes. So the video that's just about to come out on YouTube this weekend, I'll be talking about things which might trigger a sell-off. And of course the taper tantrum is one of them. Now, a lot of people were spooked, I think, by the Fed and what they said. I think the bit that freaked people out was when they said that most participants noted that, with the usual hedges about the economy evolving as they anticipate, they judged it could be appropriate to start reducing the pace of asset purchases this year. So now we're talking about tapering within 2021. Now, of course, the threshold for raising interest rates is much higher. To simply taper, they only have to see substantial progress towards their dual mandate of full employment and price stability. But but then to raise interest rates, there's a more stringent criterion, which is that they have to have effectively full employment, whatever they judge that to be. So that could take a lot longer. But that seems to be what spooked markets, because it's kind of perhaps sooner than people expected, the taper. But obviously tapering is just reducing the rate of asset purchases. So instead of purchasing $120 billion a month of treasuries and mortgage-backed security, they're just going to purchase less at a slower rate every month. So that's the plan. And there's also a nice economic summary of the US economy and the global economy in that set of Fed Minutes. So I strongly recommend you have a look at those. I'll be talking about it in my weekly roundup. If you haven't signed up for that, why not do it? Because it's free. Again, I think there'll be a link to that in the description. Laura says, very good. So you can read about that in the weekly. Right, so let's get on to your questions. And the first one I think is from one of our supporters. It is Arsenio. Good to hear from you. Say you're 63 and will retire in 2 years. You inherited 150k cash. Would you drip feed in the cheapest diversified 100% developed market equity fund over 2 to 3 years, or invest also in bonds, gold, and maybe REITs? And if so, in which percentage? Right, so what we're talking about here is someone who's 63. Now, obviously, they're not going to just give up after 2 years. They're going to be invested until they pass away, presumably. So if that's the case, they're going to be around for 20 years at least. So if that's the case, then 2 decades means, you will be investing for some period of time. And that means, the equity allocation can actually be quite high. Now, what some people do is they're very cautious at the point of retirement, because if equity markets fall and you start withdrawing money by selling equity, then you're going to crystallize losses. So what they do is they have bonds and equity, and they exhaust the bonds first. And those bonds will get depleted, exhausted, and they'll end up with a 100% equity portfolio. Turns out that's the best way to sequence your retirement sales in order to generate income. So, historically, that would have given you the best way of running your investments down so that, you can pay for your living expenses. So I think that's probably what I do. So a combination perhaps of REITs, a small percentage of REITs, maybe 15%, a lot of equity probably. But it really depends on other stuff. So maybe they have another source of income. Perhaps they have multiple pensions. So many people I speak to have a kind of trail of pensions from previous occupation. Some have defined benefit pensions. So, they're effectively taking no market risk with those. So it really depends on the circumstances of the individual. Some people may have an illness which shortens their life, in which case, investment might not be the best way to approach it. Some people have children that they want to leave money to. So it really depends on your goals. But that's probably the way I'd approach it. Cautious at first, deplete the bonds first, and then you end up with a very large equity allocation as you get older and older. So that's usually the opposite is what you'd expect from target retirement funds. But it turns out that in retirement, that's the best way to draw down. Sell the bonds first, ramp up the equity, and just leave this world with 100% equity. And in terms of the starting point, well, really it depends on how much risk you're willing to take. If people are very risk tolerant, then you could have quite a high equity percentage. But it really depends on how those people feel about having lots of equity. And that would usually revolve around questions like, if equity markets fell 50%, would you be tempted to sell? If the answer is yes, then they don't want 100% equity. So it's just a question of what loss they'd be comfortable with in those kind of drawdown scenarios. And that's probably the way I'd approach it. Okay, next question. Stephen J, who says, if CPI, that's the Consumer Price Index, is above break-even inflation, you say we should be in inflation-linked bonds. But as the CPI is a few months behind, this isn't accurate. Do you think we should be some bit invested in? Is that the whole question? Anyway, yeah, okay, so let's just break that down.
No, I've got more.
Oh, there's more to come. There's more to come. Okay, so let's just have a look at the actual break-evens. So what I'm going to do is pull up a spreadsheet of break-evens for the Bank of England. Now, this is really difficult to find. You really have to dig into the Bank of England website to find it. But what I'm going to try and do is bring up the spreadsheet. Now, break-even inflation, Bank of England, should be break-evens here somewhere. Break-even. Nope, let me look at spreadsheets. Spreadsheets. And you will see this appear in a moment, I promise. So the way break-even inflation works is what period of time. So let's say you buy a 10-year UK government bond, right? So the alternative might be to buy a 10-year inflation-linked bond. Now, when these two bonds are issued, the inflation-linked bond will have a lower coupon than the non-inflation-linked, the normal government bond. So you'll receive a smaller initial income for the inflation-linked bond. If inflation rises over time, which it always does, almost always does, then the principal of the inflation-linked bond will increase in line with inflation with a 6-month lag. Now, what you're betting on is over the course of the life of the bond, inflation will be above the break-even rate. The break-even rate is the rate at which the rate of inflation which is priced in by the market, such that the bond, the inflation-linked bond, would give you the same income as the government bond. So in order to win, if you like, to get a higher income than's priced into the markets, inflation has to average more than the break-even. So if the break-even's, say, 5%, then it's very unlikely that we're going to hit that break-even over the life of the bond. So that's why break-evens really matter when you're deciding to buy government bonds. I'm getting there. Here we go. Bank of England break-evens. Bank of England inflation break-evens. So now I can share my screen and you can see this. Let me just share that. And I'll do picture in picture. Right, so this is what it looks like, the spreadsheet. And so the numbers are here on the left-hand column, and this is the graph of break-even inflation. So when I last updated this was a while ago, actually. I think it was May this year. I don't imagine it's hugely different now, but at that point, the break-even was 3.6%, the 10-year break-even inflation for UK government bonds. So that means that if you buy a 10-year UK government bond, inflation-linked, inflation would have to average more than 3.6% over the next 10 years in order for the inflation-linked bond to be better than a normal government bond. So that's the way it works. Now, obviously, the Bank of England is going to try and keep inflation below 2 or at 2% over the next 10 years. So what you'd have to assume is that the Bank of England would fail to do that. Personally, I think that's unlikely, given inflation's been pretty low in the UK over the last 2 decades. So I really don't think inflation-linked bonds would be a great investment at the moment because those break-evens are very high. But if you do want to try and dig this out of the Bank of England's website yourself, go to bankofengland.co.uk, statistics, yield curves, and go to this section, which is archive yield curve data monthly. And the file you want is this one, monthly government liability curve, inflation. And if you download that and look in the archive file, you'll see something like this. And then you can work out the break-evens. And the file name is called GLC Inflation Month, GLC Inflation Month-End Data 2016 to present. So hard to find. And you compare that with Fred and it's really easy to find for the US. So I wish the Bank of England had something equivalent. Right. So let me just remind you, like our stream, please, and subscribe to our channel, and it helps us a lot if you do that. So if you're watching it in replay, please do like our video because then other people find out about it. And so let's just see if we have any other questions. Stephen asked about break-even inflation. Oh, the second part of his question, inflation-linked bonds all the time. I think we should be some bit invested in inflation-linked bonds all the time in case the Fed takes their hand off the wheel if we're invested in bonds. For example, 20% inflation-linked bonds, 80% nominal. No, I don't think that's a good idea because of this break-even effect. Most of the time you're not better off with inflation-linked bonds if the break-even's pretty high. And at the moment, certainly for the UK, it is high. So just look at the break-evens for the US, just see whether you think inflation will exceed that over the duration of the fund, if it's a fund you've bought. But if you want a tail hedge, maybe. But I think it's just given recent history, I think it's unlikely we're going to suddenly see inflation spike again after we've had this spike recently. And it is looking transitory at the moment. The two components which have pushed up inflation a lot seem to be, if you look at the monthly data, seem to be ebbing now. So I think it's looking transitory anyway for the US. And in the UK and in Europe, there isn't much inflation. It's around 2%. Okay, next question from Gary. Congratulations to you and Laura for 100k.
Yes.
Yes. For 100k subscribers. If REITs are a cyclical asset class, then is it really diversification away from equity? No, it's not. And because one of the things about REITs is they're highly correlated with equity. So if you buy UK REITs and you buy UK equity, you'll see the correlation of those two is very high. Those two asset classes is very high, usually around 60% at least, sometimes higher, sometimes lower. But generally, it's not going to give you much diversification because unless you go for an unusual sector for REITs, so mortgage REITs, for example, might have a lower correlation to equity than commercial property REITs, for example, because that's more of an uncorrelated market. But all of them are cyclical. So almost any REIT that you buy will be cyclical, which means that if there's a recession, the returns will be poor. If there's an economic boom, the returns will be good. Kind of like equity, although the linkage is not too strong. But yeah, both are cyclicals, so it doesn't really give you much of a hedge at all. So if you are going to buy REITs, just understand that it's like equity. The volatility is high, trades on a stock exchange, and you are taking a big capital risk. But if you are willing to hold it for a long period of time, then it can give you good total returns in theory. But again, you have to be careful about sectors and diversification, the same as you are for equity, really. So many of the things which apply to equity investing apply to REITs as well. But it is a kind of like a kind of sister, a kind of sibling of equity. That's the way I think of it. Some people I've spoken to think of REITs, real estate investment trusts, as being like bonds, but they're really not. It's not a safe investment. It really is risky. It's a risky asset class. When equity sells off, so will REITs. Okay, so let's move on to another question. And I think that's it for the questions on Slack. So I'll move back to everybody else. Right, so I'll start at the top. So Maria says, how can we know the figures of withholding tax taken on our US ETF investments? I guess that amount can be deducted in our UK tax returns. Yeah, you can find out what the withholding tax is by looking it up. So if you know the domicile of the fund, Luxembourg say, and you know where the instrument is investing, the US, then you should be able to look up the withholding tax for those two countries. You may be able to ask the fund manager what the withholding tax is, or if you go for, instead of going for a fund which is physically replicated, you can go for a fund which is synthetic, where they're actually using something called a total return swap, where you don't pay withholding tax. Now, BlackRock has started offering some synthetic ETFs, for example, an S&P tracker, where you will get a higher income because it's a synthetic tracked index because of the derivative embedded inside it. Now, you will be taking some counterparty risk, the fund manager will, so there's always the risk that the company they've taken the derivative out with will potentially run into financial difficulty and they could make a loss as a result. But these things now are highly collateralized, so usually every week, if there's money owed, the money would change hands. They call those reset dates. So the most you'll lose is how much the market's fallen since the last reset date. And usually they'll be over collateralized, so the risk is fairly low to both counterparties, actually. So I'm not particularly concerned about the risks of a synthetic fund. So maybe that's a better way to go, because then you won't pay withholding tax. That might be a better option. Then you don't have to know about it, which is much better. Question from Alex. US investors can know price to earnings ratio for ETFs on the ETFDB site. In the UK, I can't find the PE on just ETF. On fact sheets, on key investor information documents, etc. Any idea on where I could get it? No. And it's something I really miss on Bloomberg, which is the look-through functionality where you can drill into the individual stocks in a fund to work out their PEs, the price to earnings ratio, so you know how expensive either in aggregate a fund is or individual stocks are. So at the moment, what I'm finding I have to do is look up the individual stocks and then work out the PE on those stocks, which is very painful. But the quality of data for UK investors is generally not as good as the US, which is an unfortunate consequence of having a less developed financial market here, unfortunately. So unfortunately, I don't know how you could do that, Alex. If you find out, tell me, because I'd love to know.
Share.
Oh yes, like our stream and share, because then other people will know that this is helpful, because we do try to help as much as we can. That's our goal, to educate and inform, not to scare, which I think a lot of YouTubers tend to do, unfortunately. Yes. So Susie says, good afternoon, Ramin and everyone. What would you buy if there was a 20% crash in the stock market? Well, I mean, I've got things on my shopping list I can share with you. I think that's what you're asking. I mean, personally, I think some funds which are, expensive at the moment still would be Scottish Mortgage. So that's a innovative, disruptive stock investment fund, a big growth fund in the UK, the UK equivalent of Cathy Wood's ARK fund, probably. But that has very expensive stocks in it at the moment, because after the pandemania rally, some stocks have just become hugely overpriced. So if there was a big correction, I guess 20% isn't a correction, it's just a bear market, but still not, a crash. But even with a 20% lower price, I think that would be attractive. So Scottish Mortgage would be one thing. Battery investments, perhaps, funds which are thematic funds which invest in battery technology. I think that's interesting as a theme. Another theme which is interesting is biotechnology, but also healthcare disruption. That's an interesting theme, I think. Some Chinese equity, I think, might be something I'd consider. Although, given what's happened recently, that's already at a huge discount. So I took a bit of a hit on the K-Web fund, I've got to say. But that could be interesting, because I think longer term that could still have interesting returns, particularly if it was bought at a discount. Other things I might consider would be high yield credit, because credit spreads are currently very tight in the US, and if equity sold off, I'm sure those spreads would widen, and then you'd have a much more attractive return on high yield credit. And maybe emerging market sovereign debt while we're talking about fixed income. Again, fairly tight spreads at the moment, and if equity sold off, those would widen, and it would be a better entry point to that market. So really, whatever themes you think would be attractive, but which currently are too expensive because of the pandemania rally. But those would be on my list, probably. There was one other actually that I was discussing with a client this week, and I thought, oh, that looks interesting, and I've completely forgotten what it is, so I can't tell you. Right, next question. That's one of the benefits of the Power Hours, which is that people give you brilliant ideas. It's amazing how creative people are and the ideas they come up with. So the Power Hours are a real privilege. And if you do want to have a Power Hour with me, it's not just one way. I don't learn from you necessarily, but hopefully you kind of gain some benefit from what I do, which is to look over your portfolio and just act as a sounding board for your investments. So if you want me to look at those investments, just to make sure that they're doing what you think they are. And often we find that the portfolio is not expressing your views. And if that's the case, we can talk about how to align your views and your investments better. But what I don't do is tell you what to do, because that's advice. All I do is kind of provide education about how to build a portfolio, and you can bounce ideas off me. And I can suggest ideas which you can then pursue yourself. But ultimately, the decisions are yours. So that's the way the Power Hours work. And you can look those up on our website. Just go to pensioncraft.com/powerhour, and you can find how to book those. Okay, there's another question here from Arsenio. Should I answer that one, Laura?
Sorry?
Is there one from Arsenio here?
Yeah, you answered it already.
Okay. There's one about drip feeding. Yeah, that was a drip feeding one, wasn't it? Okay. Okay, back to non-members. Okay, so Eric says, Ramin, love the channel. Thank you, Eric. Eric Henson. I converted my cash ISA last year. I'm guessing you converted it to a stocks and shares ISA. I invested a lump sum in equities, yes, must have done, during last year's dip, and have been pound cost average since then, and you've got 100% equity. But I've still got a portion of cash left in case the market tanks. Okay. What's your strategy for lump sum investing in case the market drops? Do you set certain thresholds? Well, I mean, I did backtest this to see whether it was possible to find a level of expensiveness or cheapness where it's worthwhile holding back your money, waiting for equity markets to get cheap enough to invest. And it never was the case using Shiller's excess cape yield measure. It never was the case that it was worthwhile holding back money. It was always the case that it was better to be 100% equity invested. So is the fact that markets are expensive a reason to hold back your money? No, that was the upshot of what I did. So even when markets are expensive, they often get more expensive, in other words. So that's why when people say, you know, markets are expensive, you should sell, it's just not true, because markets carry on getting more expensive often, most of the time, in fact. And if you look at the percentage of time markets are at all-time highs, that happens quite a lot. So that's not unusual either. So if you've seen headlines about markets are at all-time highs, you know the person who wrote it is an idiot. Okay, next question. Oh no, there's another one from Eric, which is, if equities drop 5%, you'd invest 25% of that cash. Down 10%, you'd invest 50%. I think these are examples of how you might do it. Curious to know how you'd approach spending that cash balance in case of a correction in the equity markets. I'd probably look at valuations and I'd compare them with a 5 and 10-year average. I'd look at the US market because that's where I can find the valuations, as we've already discussed. And if it drops below the 10-year average, then I'd consider putting everything into equity, because at that point equity markets are very cheap. So certainly a big chunk, 50% of my cash, I'd convert at price to earnings multiples which are less than the 10-year average, probably. But that's how I'd measure it. I'd look at the price to earnings multiple, because what's odd is that valuations are a good measure to help you know when to get into markets after a crash. But before a crash, they're not predictive of whether markets will crash. So even if markets are very elevated in terms of valuation, high valuation doesn't tell you about the timing of getting into markets. Whereas if equity markets have fallen and you want to know whether there's a good entry point or not, valuations do provide a good way of knowing that things are now cheap. So that's the way I'd approach it, certainly at the index level. Remember that for the single stocks in an equity market correction or in a recession, those can go to zero. And in fact, the rate of defaults, the rate of bankruptcies increases during a recession. So using the cheap metric for single stocks during a recession is risky, much more risky than an index, because the stocks might not recover. Whereas indexes always recover, or at least in developed markets, they recover. Most of the time. Right, so next question. My whole portfolio is red. Oh dear, I'm sorry to hear that. I suspect though that this is Apothe 6. I suspect your portfolio is red because you haven't been investing long. Because if you had been investing long, we're still up hugely over the last year. So I'm not sure what you would have bought to have a portfolio which is all red. Maybe you're just talking about a short-term return, but you should ignore those anyway. Markets fall, they rise. You should just kind of take that as like the weather. You look outside, it's raining, it's sunny. That's just the way things are. And if you're a long-term investor, you can look through volatility. That's the beauty of it. It simplifies investment a lot. And you don't get so stressed as well. I think that's a good thing. Okay. I can't pronounce your handle, but it's RGRTNYJJC. I'm not sure I can pronounce that without injuring myself. What do you think, Ted? Unpronounceable, right? Okay. But your question, congratulations on 100,000 subs. Thank you. Can you explain how Vanguard calculate the personal rate of return on their account? I can, as it happens, because this is a question which was asked on our YouTube, on our membership for Patreon. And if you want to replicate it, it's called the internal rate of return. There's a function in Excel called XIRR. And what you do is, so let me just quickly sketch how it works just to show you. Now I'm going to do some very bad drawing now, so just brace yourselves. Okay, so hopefully you can see my screen now. Okay, here we go. Bad drawing time. So cash flows. So let's say you invest some money, right? So investment is a downwards arrow, okay? And then you start receiving income. So maybe you get some dividends, maybe you sell one of your funds. So sale is in blue, and then you buy a bit more, maybe. There's another little purchase here, and then you get some more dividends. So what you'll end up with is a kind of grab bag of cash flows. Let's make the dividend a bit bigger this time because there's a special dividend. And then you sell your holdings, right? Or some of your holdings. So this is what your cash flows look like. So as we go from left to right, that's time along the bottom axis, yeah? So this is time, and these are cash flows. So what you do now is you enter the dates of each of these transactions into a spreadsheet. So it goes date, size of cash flow, date, size of cash flow, date, size of cash flow. And if it's a black one or a blue one, in other words, it's an input, it's an incoming cash flow, you make it positive. So the cash flow will be positive. So the first three are positive, and then we get to one which is negative. So this cash flow will be negative. And then what you can do is use the XIRR function, XIRR. That should be an X, that's not very clear. And I think you give it an array. You just enter this whole array into the XIRR function. And then it'll give you the internal rate of return of those cash flows, which is kind of like the single rate of return that would have given you the return on your investments. So that's how they aggregate everything into one number. And there is a kind of degree of arbitrariness in how you calculate that, but that's how Vanguard does it, XIRR. And there are other ways of doing this, but which I discussed in that video. But anyway, this is how Vanguard does it. And you should be able to replicate it if you take the cash flows from Vanguard and you use the XIRR function in Excel or on Google Sheets, which is how I do it usually. And the example I gave for Patreon was using Google Sheets. Right, back to the questions. Yeah, so do like our channel and do subscribe. Now we're past 100,000. We still value your subscription if you're watching this in replay. And yeah, that would really help us a lot if you do that. Oh, somebody's saying no audio.
No, don't worry, that's sorted.
Oh, good, good, good. Right, audio's fine. A crisis I didn't even know about. Good. Okay. Okay. More about audio. Okay, inflation-linked bonds. Ramin. Oh, here we go. Batman, very good, says, any opinion on saving money on a high-interest crypto platform without actually owning crypto itself, e.g. BlockFi pays 7.5% on USDC balances. Yeah, that's the way I did it in my video. I mean, strictly speaking, what I did was centralized, not decentralized. You can do it yourself, but that certainly comes with a higher level of understanding required. So if you do have stablecoin, then you can at least you can actually do this yourself. But it's much easier, I think, to do it through one of these centralized finance platforms because there's less learning required, and there is a degree of safety, I suspect, because I think what's going to happen over time is that these centralized DeFi platforms will become regulated. I think that's almost inevitable. And the Fed is talking about regulating stablecoin just like they regulate money markets, because they actually satisfy similar roles in the financial system. So I think that's probably the way we're moving. More regulation, and that'll protect people. I mean, remember, the reason why we have regulation is to protect investors. But you can certainly get a pretty good yield. I was surprised at how much you could get on systems like BlockFi and on another platform which I used which was Nexo, and Celsius is the other one that people often use. But I certainly wouldn't put too much money onto those platforms at the moment, because it does come with a risk. They could get hacked, and if you don't own the keys, then you've lost your money. Now, BlockFi has insurance, I believe, but it doesn't cover the entire holdings of the fund, the entire holdings of BlockFi. So, you'd only be able to reclaim some of your money if it all got stolen. So it certainly comes with a big capital risk. It's still not regulated, so I'd still be concerned about that. But wouldn't it be great if it did come with some kind of guarantee, just like the FDIC guarantee in the US, the FSCS guarantee in the UK, if you were buying stablecoin? That would be great. But of course, the consequence of that would probably be lower income if it was safer. So you can't get free lunch in investment, unfortunately. Right, next question from Simone, who says, do you think that owning Chinese bonds is risky? Yes, I do. I do think that's risky. I mean, obviously, you've got corporate bonds in China. You've got government bonds as well. Now, I think what's very unlikely is that you'd lose money on Chinese government bonds, simply because China or any government doesn't want to make it more expensive for themselves to borrow money. I mean, China probably doesn't need it because they have such huge foreign reserves, trillions, 3 trillion-ish in foreign reserves. But, it's always nice to have that option of being able to borrow in the bond markets. So government bonds, I think, fairly safe, but they are emerging markets, so not that safe, nowhere like treasuries. Plus, you're probably taking the currency risk. I don't think they have hedged renminbi government bonds, as far as I know. So you'd be taking the currency hedge. So you wouldn't be currency hedged, so you'd be taking the currency risk. Chinese the Chinese yuan relative to developed market currencies is not too volatile for an EM currency, but that could change fairly quickly depending on what happens politically. So yeah, that's a risk. Government bonds, okay-ish. Corporate bonds I'd be more worried about, given that the new policy from the government seems to be to allow companies to default. Previously, if a company was kind of state-owned, it was assumed that they'd be bailed out. They couldn't default. But we've seen several Chinese companies which are kind of state-owned, some coal companies, for example, in some provinces of China, which did default. And clearly that's the new policy, which is to let some of these companies default, and so that obviously you take a capital loss if you'd bought the bonds. So just be very selective about whose bonds you buy, just the same as you'd be for corporate bonds in developed markets. So yeah, I'd certainly consider it, but just be aware that it comes with a higher risk. So it's more risky than developed, obviously. That's why the yields are higher, both for the government bonds and for the corporate bonds. And what you've always got to think is, given the extra income you're receiving for taking the China credit political risk, are you being compensated enough? So I'd compare with this spread. I'd compare the yield you're getting on Chinese bonds with, say, US Treasuries, and just think, well, is that difference sufficient compensation for that risk I'm taking? If it isn't, don't buy it. If it is, then yeah. But really, that's a subjective decision. You've got to decide whether you think the compensation is enough. But just make sure you match duration. So if it's a 7-year fund, you'd compare with a 7-year Treasury fund, perhaps, just to make sure you're comparing the durations which are equivalent. But once you do that, you can work out the spread, how much additional yield you're being paid, and then just think, is that enough? Right, that's how I do it. But I can't tell you whether you think that's sufficient, because your view of China risk might be different from mine. But I'd say it's significant. So if I wasn't, so let's say it's a 10-year fund, I'd expect at least 2-3% extra yield for taking the China risk for that fund, because I'd want to be compensated. And I suspect the spreads aren't that big at the moment, just as they're not in many other fixed income markets. Okay. Some people saying that they also took a hit with KWeb. So it's good to know I'm not alone there. But it's interesting. There are lots of inflows into the KWeb China Internet Fund. It's a fund from Crane Shares. There were big flows into the fund, but those have now slowed down as there's very little evidence that the fund is recovering in terms of price. So maybe it's too soon, but I think probably, long term that'll be an okay one. Unfortunately, it gets its exposure with ADRs, which depend on variable interest entities, which China might suddenly turn around and say are no longer viable. So, that's a risk. Maybe that's why people are keeping away. Someone says that my voice is very soothing. And despite the knowledge he gets from this Q&A, live Q&A, I just come to listen to your voice. It's just so soothing and meditative. Now, poor Laura has to listen to all of these videos, and she's shaking her head. It's no longer soothing for her, bless her. No. And Teddy hates it. He hates the voice, because whenever I talk on one of these sessions, I always talk loudly. So he thinks it's my shouty voice, and he gets scared. So Teddy doesn't like it, but he does like the treats. Right. Anyway, you said there is a question. I have a question. I'm really split on whether I should start using spare change investing apps. If yes, which one would you recommend? Plum or Moneybox, or anything else you think is better? Yeah, I looked at Plum and Moneybox. I think what was surprising about Moneybox was the high fees that you're going to pay for the funds which you get. I think it was something like 1%. It's very high from memory. Maybe not 1, but certainly chunky. So if you're paying more than about 0.2% for the platform fee and the fund fee in total, then you're probably paying too much. Because remember with Vanguard, you know, they now set the kind of standard, which is 0.15% management fee, and say 0.1% for your funds. So if you're paying more than about, you know, 0.25% every year in management fees and fund fees, that's too much. You could do better. And so, yeah, I think probably, I seem to remember that Plum, I really liked Plum. I can't remember why, because I'm a nerd probably, but both of them are kind of nerdy. But I seem to remember Plum was more attractive for some reason. I remember now. Plum has kind of AI built into it, so it can kind of get used to your spending patterns and learn how much you've got to spare, and then try to be smart about putting money into savings. That's what I liked about it. So I kind of like that one. But just keep your eye on the fees. You might be better off just doing it yourself, right? Usually that's the case. If you can be bothered to sweep your excess cash into a brokerage account, a platform account, into an ISA, then why not just do it yourself? It'll probably be cheaper. Plus you get the reward of being able to choose your own funds, which is much more fun. Okay, next question is for how are we doing for time? We've got 13 minutes, so please do like our stream. Also, you can share and you can subscribe to our channel, because if you like our Q&A, you'll probably like our videos as well. And next question is from Brian Nickel, who says, a question on fund fees. If a fund, let's say Vanguard Life Strategy, is made up of other funds, am I paying the underlying fund fee plus the headline fund charge? Now, I think it's the case that that's not true. So what you see is the total expense ratio. And the reason why that's true is that the expense ratio is actually paid by subtracting from your return. And I believe that it's a legal requirement that when a company publishes an ongoing charges figure, an OCF, they have to quote the all-in fee. So if it's a fund of funds, they have to aggregate the fees. And the way you're charged, so let's say the fee is 1%. Every trading day, you'll subtract 1/252th, that's the number of trading days in a year, 1/252th of 1% from your return. So it's almost invisible on a daily basis, the drag on return. But obviously over a whole year, that 1% will have been subtracted. And the fund manager may try to boost the return so that the tracking error is not negative, but sometimes they don't manage that. But that's the fee that you'll be paying. And it will be an all-in fee. So that's how it's calculated, I believe. Sean says, congrats on the 100k, thank you. With average house price in the UK being 8 times the average salary, do you think a housing crash is on the way? It was 8 times in 2008. Again, you know, these kind of valuation things don't work for the housing market in the same way they don't work for equity. And as long as the kind of impetus is there for people to carry on thinking that houses are an incredible investment, I think people will carry on buying regardless of price. So it takes, I think, a shock, usually an economic shock or very high unemployment, a spike in unemployment, to kind of reset the market. And we haven't had one of those in the UK for some time now. Even during the pandemic, we had the furlough schemes, which are now starting to wind down. So we might see a spike in unemployment, which might trigger a correction, a shock, a reset of that market. But I don't think just because valuations are high, based on price to rent ratios or price to income, I don't think it's necessarily true that we're going to get a reset. The other thing to look at is the regional disparity in house prices. Again, let me see if I can quickly find this because it's really interesting. Price to income ratio map. Yes, I think this is it. Oh yes, I found it. Very good. So let me just share my screen so you can see this. And I'll be picture in picture. All right, here we go. Hopefully you can see that. I'll make it a bit bigger. Now what this shows you is the property price to earnings ratio for the UK. Now notice there's a huge disparity. So if we go to Kensington, which I think is the most expensive, yeah, the property price to earnings ratio in Kensington is 40.7. So, 41 times the income, the average income for Kensington and Chelsea. Whereas if we go somewhere in the north, say, so if we're in Durham, County Durham, there it's much lower. In fact, it's, let's see if we can work out what it is. No, we can't, unfortunately. So, but it looks like it's it's less than 4.5, if anything less than that. And it's interesting how it's changed over time as well. You can kind of play a movie of how those price to income ratios have changed over time. And what's notable is how much it's increased. Now, obviously, it won't trend upwards forever because otherwise, houses would just become unaffordable for everybody, which can't happen forever. But it is noticeable that, as we go over time, what's happened is that, price to earnings ratios have increased fairly gradually, but are now at very high levels. So you're right, ultimately it's unsustainable, but it'll take a shock to make it stop, I think. Good question, interesting. Right, back to... Oh, here we go. I'm back. Let me just close that. Right. Alexander Konopko. What do you think about leverage ETFs portfolio? Like mixing 50% UPRO, which is 3 times the S&P 500, and 50% TMF. So that's 3 times 20-year bonds. Interesting, right? I've actually tried playing with this myself. I don't use those funds. I use a wisdom tree 3 times S&P 500. And obviously it's been doing well recently. But what I've actually done is to backtest it by taking Shiller data and projecting it back in time to see what would have happened with the 3 times daily return. Well, 3 times monthly return, I guess I'd have to use. Oh no, that's not what I did. I did the daily returns, which I had going back to 1960, I think, for the S&P. And I looked to see what would have happened if I'd have invested in that. Now, obviously, the problem with 3 times leveraged funds is all of the cognitive biases are multiplied. So if I'm scared of a loss, which I am, quite a cautious person, and I see that I've lost 80% in a crisis. So let's say a recent one would be the global financial crisis. So instead of losing 50%, I lose 80% because of the 3 times leverage. I'm much more likely to do the bad behavior which would lose money, which is to sell. Another way to think of it is if your hand's in the fire, you're tempted to take your hand out of the fire. But the hotter that fire is, the more likely you're to take your hand out. And similarly for leveraged funds, if you make a leveraged loss, you're much more likely to sell, I think. And that's what the problem I see with it. So even though financially it's actually better than having an unlevered fund, the cognitive biases make it more dangerous, I think. Because if you're the kind of person that would be scared in a normal sell-off, you'll be much more scared with a leveraged sell-off. So a 3 times fund is probably the way to do it because you never end up owing more than you invest. Whereas if you have something like a contract for difference, you could actually end up owing more than you invest because you get margin calls. So I think if you are going to do it, the 3 times funds are one way to do it, maybe a 2 times fund for less leverage. But obviously these things come with a huge warning, which is that firstly, it's not going to match the long-term returns multiplied by 3 because it's matching the daily returns. And because of gamma effects, you don't get that. You don't get the long-term return multiplied by 3. So just be aware of that. What you'll get is daily returns multiplied by 3, which is very different. But that's, I mean, I could give a whole video about that. So yeah, I think for some people, you know, it might be fun to do it, but just don't risk too much of your portfolio with it. You can really do very well without leverage. And I only did it because people asked me about it. And if you do have the 3 times treasury fund, yeah, I guess what you'll end up with is a kind of levered 60-40 or whatever you choose portfolio. So you do have that hedge in place for when equity markets sell off. I was going to do that, but I can't get the Wisdom Tree 3 times treasury fund because there isn't one available with my broker. So I couldn't hedge it. So I've just got the unhedged 3 times S&P at the moment. So I'm going to be crying on one of these calls in the not too distant future, I suspect. So we've got 3 minutes to go. I'm going to answer one more question. And this one is from there's a question about Alibaba, but it's a single stock thing, so I probably wouldn't be a good person to ask about it. People getting hit by K-Web. Oh, here we go. So oh, but you've already asked a question, so I'm going to ask another one. Tom Otto. So he's asking about surely variable interest entities benefit China too. So this is talking about the structure which currently China uses to allow foreigners to invest in their companies. Now, they've never officially said it's okay, and it's never been tested in a courtroom in China to see whether variable interest entities are legal. So the Chinese government could turn around and say, these aren't going to be valid anymore. That's the risk. But as you're saying, Tom, it's in China's interest to have VIEs because it means companies like Alibaba have access to massive pools of capital outside China, in the US, in the UK, in Europe. So it is in their interest to have that. But I wonder if politically, you know, they've decided that they'd rather go down the domestic market route for raising capital and keep the profits as well, rather than allowing foreigners to do it. You know, because America's obviously thinking about restricting Chinese listings on their exchanges. So perhaps this is a kind of tit-for-tat retaliation from China. But I agree, it seems foolish to me. But, you know, I suppose if you're someone in the Chinese Communist Party in a position of power, you're more worried about political stability and control over your population than you are about having free markets, because that's an ideological thing which they may not share. So I don't think we should impose our belief systems on theirs. You know, that's probably the justification for it. Finally, Colm says, I'm a physicist too. Tell us about your biophysics PhD topic. Well, I was looking for the molecular mechanism for anesthesia. So I was working on anesthetics like isoflurane and trying to find out which the target sites were, the molecular target sites in the human brain. And yeah, it turns out that nicotinic acetylcholine receptors, which is, you know, if you smoke a cigarette, the receptors which get stimulated when you smoke a cigarette in your brain are the same ones that are very sensitive to anesthetic. So there's an interesting fact that you probably weren't expecting on tonight's call. The target site for anesthesia is the same as where it is, you know, the target site for fags. I shouldn't use the word fags because there are some Americans listening to this as well. Cigarettes. Okay, and on that bombshell, I think we'll end it there. And thank you all for joining us. Remember, you can like our stream and you can subscribe. We now have 100,000 subscribers, but more are always welcome. and have a great 2 weeks. I hope you have a lot of success with your portfolio, and we'll see you in 2 weeks' time. Bye, everyone.